2008 financial crisis, also known as the global financial crisis, was a severe economic downturn that began in the United States and quickly spread to other parts of the world. The crisis was triggered by a combination of factors, including a housing bubble, risky lending practices, and complex financial instruments that were not well understood by many investors and regulators. When the housing bubble burst, the value of many financial assets, particularly mortgage-backed securities, plummeted, leading to widespread losses and financial instability. This, in turn, led to a severe credit crunch, as banks and other financial institutions became unwilling or unable to lend money, exacerbating the economic downturn. The crisis had a significant impact on the global economy, leading to a sharp contraction in economic activity, rising unemployment, and a decline in consumer confidence. Many countries experienced recessions, and some, particularly in Europe, struggled with high levels of government debt and slow economic growth in the years following the crisis. Governments and central banks around the world implemented a range of policy measures to stabilize financial markets and support economic activity, including massive fiscal stimulus packages, bailouts of failing financial institutions, and unprecedented monetary easing. While these measures helped to prevent a more severe economic downturn, the crisis highlighted the need for stronger financial regulation and oversight to prevent similar crises in the future. Explanation of how the stock market crash was a significant factor in the crisis. The stock market crash was a significant factor in the 2008 financial crisis because it was closely tied to the housing bubble and the financial instruments that were used to finance it. As the housing market boomed in the year 2000, investors and financial institutions became increasingly focused on mortgage-backed securities, which were bundled together from thousands of individual mortgages and sold as complex financial products to investors. These securities were rated as safe investments by rating agencies, but in reality, they were backed by subprime mortgages that were increasingly risky and likely to default. As defaults on these mortgages began to rise, the value of mortgage-backed securities plummeted, causing significant losses for investors and financial institutions that held them. This, in turn, led to a crisis of confidence in the financial system, as banks and other institutions began to question the value of their assets and became reluctant to lend money to one another. The stock market crash made the situation worse by causing a sharp decline in the value of many stocks, leading to further losses for investors and a decline in consumer confidence. The collapse of Lehman Brothers, a major investment bank, in September 2008 also had a significant impact on the stock market and the broader financial system. The bank had a large exposure to mortgage-backed securities and other complex financial products, and its collapse triggered a wave of panic selling and further declines in stock prices. Overall, the stock market crash was a significant factor in the 2008 financial crisis because it was tied to the underlying problems in the housing market and the financial instruments that were used to finance it. When these problems became apparent, investors and financial institutions lost confidence in the financial system, leading to a sharp contraction in credit and a severe economic downturn. If you like the video, please hit that like button and subscribe for part 2. Thanks for watching.